Well, good evening, everyone. My name is Scott Mann, and I'm here tonight with my brother Travis Mann, my partner as well, and also Sean McKay. We're going to all be co-hosting this webinar tonight. First of all, I just want to welcome everyone to what we believe will be the first of many Green to Gold webinars that are designed to help our military members and friends of the military achieve their objectives for financial freedom. I also want to thank all of you for taking the time to dial in tonight to this webinar. I realize that on a weeknight like this, everybody is extremely busy, a lot going on, and we certainly appreciate the fact that you've taken the time to spend an hour tonight with us and hopefully invest in your financial intelligence. Tonight's topic is going to be on self-directed investing with individual retirement accounts, or IRAs, and also on how self-directed IRAs can benefit you financially if you direct them towards Pisgah Brothers, which is the company that Travis and I own. So it's kind of a two-part thing. I'll talk more about that in a few minutes. As I said earlier, we have my brother and partner Travis Mann with us tonight, and also Sean McKay of American IRA is here, and I'll introduce him shortly. Before we begin, I'd like to make a few admin announcements. First of all, we're going to do everything we can tonight to finish on time. As I said, everybody's busy, certainly a lot going on a weeknight, so we're going to do everything we can to step through this agenda and be done in an hour. Any questions that you have for that reason, we'd ask that you hold them till the end of the session, and we'll have a question and answer period at that point. If for some reason we don't get to your question in that hour period, we'll go ahead and just announce that folks can sign off, and then Travis, Sean, and myself will remain on the line for any additional question and answer that you may have. If you do have a question, what we're going to ask you to do is just to hit there's a small hand in the top right corner of the screen. If you'll just click on that, that will actually raise your hand to Travis, and he'll be able to call on you from the panel to ask the question, or as time permits, we may even ask the question for you. We already have some questions that have been posed to us. If we do miss your question for some reason tonight due to technical constraints or an oversight, all you have to do is just email or call Travis or me immediately after the session, and we'll make sure we get you an answer quickly. And without any further ado, let's go ahead and get into the webinar. Next slide, please. So the first question, for those of you who don't know Travis or me, it might just be, who the hell are the Mann brothers? And I think that's probably a fair question. So would like to take just a minute or two to talk to you about Travis and myself, who we are and what we do, because when we're here tonight talking about investments and your money, I mean, this is your money, and certainly from a credibility and legitimacy perspective, you need to know who you're dealing with. As you can see in the picture there, Travis and I, Army officers. I'm still on active duty. Travis has since transitioned from the Army, but both Army officers. But we're also entrepreneurs. Travis and I have been on an entrepreneurial and investment journey for several years now. About 5 years ago, we set for ourselves a destination of financial freedom that we define as our passive income greater than what our expenses are, and that's the path that we have laid out for ourselves to achieve that degree of financial freedom. About 5 years later, we've managed to accrue roughly $6 million in real estate assets. Also, in a parallel fashion, we've built a pretty robust property management company that has allowed us to manage these real estate assets from a large distance. Travis living in Australia, and me deploying back and forth to Afghanistan on multiple occasions. That property management company has about a $1 million annual rent roll that it takes in, and it manages just about 250 units across 4 counties in our operating area of western and central North Carolina. So this financial path that we've been on, we've been pretty busy, and hopefully that demonstrates to you who we are, what we do, and more importantly, we tell you that simply because our message to you is that financial freedom is possible for anybody who wants it, and certainly for our friends on active duty and in the military and friends of the military, it's available to you as well. And so we lay this out for you not only for technical credibility, but we want all of our members in Green to Gold to know that that this is possible for you as well, which is a great segue to my next slide, which is Green to Gold. Green to Gold is an initiative that Travis and I have taken. It's a division of Pisgah Brothers, our company, and really it's our effort to recognize that there are a large number of folks in the military and friends of the military who desire financial freedom, but who, like us, really need a network to operate in to achieve that financial freedom. So our network consists of military members as well as friends of the military, past and present, and that's really who we're looking to reach out to for this network. Also in our network are a range of financial experts, various entrepreneurs and investors, real estate and otherwise. And these are people who Travis and I have been fortunate enough to work with over the last 5 years, who have made all the difference in mentorship and guidance to us, and who we now want to make you aware of, who can inform and educate you on the financial climate that's taking place, all the numerous changes that are taking place as the financial earth shifts beneath our feet, as well as the various opportunities that are out there. There are a ton of opportunities that are out there for investors and entrepreneurs in this chaotic climate, but to be aware of them, you really need a network and subject matter experts who can make you aware of that. And so that's why that second to last bullet there, really Green to Gold is about connecting our military members and friends of the military to these financial experts and these financial entrepreneurs and investors who have been down this path and can help show you the challenges and the opportunities that are there. Because at the end of the day, as it says in that last bullet, the ability to leverage the power of the network. We've all seen this in the military. We've all seen it in our experience with combat and those types of things, that the network is an extremely powerful entity, and when properly employed, it can really magnify your level of output. And so helping create a network of military members, friends of the military, and financial experts, we believe we're really helping to set conditions for our friends in the military and their friends to become financially free. Next slide. So our purpose tonight really is for our first webinars, we're going to focus in on something that we believe is helpful to everybody in our Green to Gold network, which is self-directed investing. You know, it never ceases to amaze me how even the most astute investors, the most experienced entrepreneurs often don't know some of the wonderful opportunities that are out there related to self-directed investing. And we feel obligated tonight to lay this out for you and make you aware of this path that you can pursue for achieving wealth through this type of investing. And so we're going to focus in on this hard tonight. And then we're going to kind of spin off of that, and there's a secondary purpose here that you see in the bottom part of the purpose statement, which is to show you some of the high-yield opportunities that you can actually achieve through self-directed investing with the company that Travis and I own, known as Pisgah Brothers, our asset-backed investments in affordable housing. Now, that's one of many ways that you can receive the rewards of self-directed investing. But we think it's very relevant to this discussion, and we'd be remiss if we didn't bring that up. So it's kind of a two-part purpose. One, we're going to drill in with Sean McKay, and he's going to show you how self-directed investing works. And then Travis and I will circle back and talk some specifics on how you can do that with our company. Next slide, please. So here's the agenda we'll follow. We've already talked a little bit about Green to Gold, and certainly in the coming weeks, Travis and I will put more collaborative venues together where we'll bring the network together and connect you to entrepreneurs and investors and continue to expose you to those things that will help build your financial intelligence. But tonight, Sean McKay is going to be our featured speaker from American IRA, and he's going to talk about self-directed investing. And then when he's done, my brother Travis is going to hit the next several topics that you see there, from what to expect and how the opportunity is defined as it pertains to affordable housing. We're going to show you how that process works, and then Travis will actually get into the numbers and show you how your investment can actually play out if you invest with Pisgah Brothers. And then we'll wrap it up with how to get started. Once all that's done, we'll open it up for any questions and discussion, and then we'll close it out and maybe even hit on some of the things that we'll be doing in the future. Next slide, please. So that takes us to the main feature of tonight's webinar. Sean McKay is going to be talking to you guys tonight about self-directed investing. Sean works for American IRA. This is the company that we primarily work with when leveraging self-directed investments, and we have found Sean to be just a real steward of this type of investing and a real professional. He's got a background in economics. He's very entrepreneurial in spirit, and he just has the kind of stuff that we have found very useful in helping people understand this program. So we look forward to giving him the chance to talk to you tonight. And without any further ado, I'll turn it over to Sean. Sean, over to you.
Thanks so much, Scott. It's certainly a pleasure to be here on this webinar. I'm Sean McKay with American IRA, and we are a provider of self-directed retirement accounts. This is essentially our basics presentation where we're going to hopefully enlighten you about what self-directed accounts are, how you can use them, go into some of the prohibited transactions, and give a few case studies. So we certainly have quite a bit of material to get to. I just wanted to highlight that the office is in Asheville, North Carolina. I currently reside in Charlotte, North Carolina. So certainly for those of you that are in the southeast part of the United States, there's a very good chance that we are the local office for you. And certainly we have clients all over the nation as well. Next slide, please. So certainly nowadays we want to make sure we get the disclaimer in there. At American IRA, we are simply the third-party administrator for your self-directed retirement account. We're certainly not attorneys or CPAs, and so certainly whenever you're making an investment decision, feel free to speak with those members of your team as well, as they are your tax and legal advisors. And so we want to make sure that you understand we are a member of the team, but by no stretch of the imagination are we the be-all and end-all for all of your self-directed knowledge. Next slide, please. So what is a self-directed retirement account? I think that there are some misconceptions out there about what a self-directed IRA or 401k is, what it can do, and so let's just delve into the basics of what a self-directed account is. With the self-directed retirement account, when we say that term, the first thing that we're stating is that the account holder is the sole decision maker in their investment career. They are going to be the sole entity making the final decisions as to what assets they are going to purchase. So certainly as the administrator, we're going to be involved in everything from the purchase through to the sale of that asset at some point in the future. But the account holder is always going to find the asset that makes sense for them, certainly working with their other team of advisors such as the attorneys and CPAs and making sure that it makes sense for their portfolio. But ultimately they are the sole driving force to make that final decision and certainly doing the diligence on those assets. With a truly self-directed retirement account, it's also important to note that you can invest in a wide variety of investment options and assets. A lot of individuals think that they have a truly self-directed retirement account simply because they get to purchase their own stocks, bonds, mutual funds, whatever the case may be, and that's a self-directed securities-based retirement account, but that isn't fully encompassing all that can be done. So it's important to understand that as we go through this presentation, there are a lot of things that can be done outside of the securities world with stocks and bonds. We have clients that invest in everything from real estate to gold and silver to private placements, whatever they think makes sense for their portfolio. But a truly self-directed IRA has a wealth of options out there for clients that are looking to take control of their financial destiny. Next slide, please. So who is American IRA and how do we fit into the puzzle? As I said, American IRA is the self-directed IRA administrator for self-directed retirement accounts. We were established in 2004 by Mr. Hitt. He's the CEO and founder of American IRA LLC. And our goal is to make the process as efficient as possible for self-directed investors. We understand that the account holder is going to make all the decisions. However, we are very much going to be a part of that entire process, and we want to make sure that, first of all, we educate you on the different options available to you. And second of all, we make the paperwork as seamless as possible. Certainly, as you open your account and you're starting to make your investments, you'll understand that this is a more hands-on process than it might be to purchase stocks, bonds, and mutual funds. And certainly that's why this is our niche in the industry. We are there to help you with that paperwork, and hopefully you'll see us as experts in this field. Certainly at American IRA, the accounts are FDIC insured, just as they would be with any retirement account with any institution. It's important to keep in mind that your retirement account itself is not changing forms in any way. So if you have a traditional IRA, a Roth IRA, 401k, any of these accounts can certainly be self-directed. Certainly if you have other types of accounts such as pension plans, thrift savings plans, etc., they can certainly be self-directed as well. It's important to understand that the account is normally not going to be changing forms in any way, just your ability to invest in what we call non-traditional assets. Next slide, please. So this good-looking man here is Jim Hitt, the CEO and founder of American IRA, LLC. And we show this slide just, if nothing else, to give you a flavor of what our ownership is about and who they are. We find that in the self-directed community, there are certainly some very solid record keepers out there. Certainly record keeping is the baseline of our business, but I think it gives us an edge when we have a owner of our company that is so well versed in the investment community himself, and it's certainly a privilege to get to work for him on a daily basis and to learn more about different investment strategies. And I think that that helps us when we're communicating with clients, because we certainly understand what they're looking to accomplish with their IRAs and 401ks, and in being able to communicate in a more efficient fashion, we can certainly serve you as the account holder in a much more efficient manner. Next slide, please. The question I certainly get on a daily basis these days is, why haven't I heard about these truly self-directed IRAs? Why haven't I heard that I can do things outside of? And the reality is, if we look at the different financial institutions that are out there, we have to understand that the large majority of individuals' IRAs and 401ks are held by institutions that strictly deal with securities-based assets. And of course, as we said, by that what we mean is the stocks, bonds, mutual funds, stuff that most of us are familiar with that we can invest in with our IRA or 401k. And that certainly can be a very solid strategy if you know and truly understand those different asset classes. But those institutions are solely set up for those sorts of investments. And so the reason why you have not heard that you can, for example, purchase a rental property or make a loan to an individual with your IRA or 401k is that the institutions that hold a lot of our retirement accounts are not able to service those sorts of assets. So it certainly doesn't make much sense for them to have conversations with us about something that they're not specifically able to assist us with. So it's not in any way that we're saying they're trying to be misleading in any way. They're just simply not necessarily as educated on these specific assets, the non-traditional assets that is our niche in the financial industry. I'm the first individual to tell you that if you're strictly going to be purchasing stocks, for example, we're probably not the best fit for you. However, if you're going to be making those non-traditional investments, we are certainly going to be a tremendous option for you, and we'd love to be of service to you in some way. But just keep in mind that this is not a new concept. The way the IRS code is written is it tells you what you cannot invest in with your IRA or 401k, and we'll certainly touch on that later in the presentation. Next slide, please. So when we're looking at retirement accounts, certainly a logical question to ask is, do I even need a retirement account, or do I have something else going on in my career and my life that will allow me to not have to worry about that? And certainly when we look at our retirement years, we need to look at it from a few different perspectives and understand that with retirement, In a perfect world, we would have income coming in from a bunch of different sources. If we look at previous generations, we understand that our parents, grandparents worked for the same company possibly for 30, 40, or 50 years, and they would retire with this tremendous pension plan. And so with that incredible pension plan, you were able to retire in style. You could travel the world. You could spend as much time as you wanted to with your friends and family, and you're staying at your consistent level of living, if you will, your ability to purchase the things you wanted to or need to. You didn't have to necessarily downgrade the lifestyle that you had because you were in your retirement. You were able to really retire in style. Unfortunately, I certainly consider myself an optimistic person, but unfortunately, if we look at the way that the economic climate is currently, many of us will not be with the same company for 20, 30, 40, or 50 years, and so that pension plan might not be an option for us. So that's something that we need to be cognizant of and understand, that because that pension plan might not be there, we need to personally be much more responsible and certainly creating our own retirement accounts and working those, contributing to those retirement accounts first and foremost, and also then investing in things that are logical and make sense for us and for our financial future. Social Security is certainly something that is an aspect, a component of you, if you will, of a solid retirement portfolio. Social Security, that's certainly, it's a nice tidbit, but that in itself is probably not going to get us where we want to go. I don't meet a lot of individuals that feel as though they can spend all of their discretionary income, everything that's that their job provides them in terms of a wage, and feel as though Social Security solely is going to be able to take care of them in their retirement years. As an individual that's in their late 20s, it's very possible that by the time I get to retirement age, Social Security might not even be around for me. So certainly individuals in their 20s, 30s, 40s, and possibly even 50s need to also be cognizant of the fact that that option might not be what it has been for previous generations. Also, there's the inheritance factor, and certainly if you're going to get that tremendous inheritance from some wealthy friend or family member, then certainly I'll be honest with you and tell you, if you're going to get $10 million from Uncle Joe, you probably don't need to worry about contributing to an IRA or a 401k on an annual basis. You're probably going to be set up, and you're going to be able to retire in style at whatever age that may be, that you can get that inheritance. But for 99.9% of us, we're not going to be in that situation. So it's really kind of a full scope. Hopefully that wasn't too negative of a full scope, but we just want to bring that idea around to you, that personal savings first of all, and then contributing to retirement accounts and growing those retirement accounts really is a financially responsible thing for all of us to be considering. So it's important that we're honest with ourselves, we're taking stock of where we are currently, where we want to go, and once we understand where we want to go, essentially working backwards from that goal to understand how we're going to get there in a logical manner. Next slide, please. So the last slide we were speaking about retirement components, what will help us, what will enable us to retire in style. So we're looking at the end result there, and as I said, we're going to need to work backwards from there. And so certainly one of the first questions that I ask myself, and my wife and I are always reviewing this on a regular basis, is our plan currently working for us? And certainly that is a question that each of us has to answer for ourselves. I think for individuals that are purely tied up in the securities world with stocks and bonds, if all of your retirement money is in those asset classes, that's certainly something that you might want to consider. Certainly the last couple of years have been a bit of a bumpy ride if we're looking at the stock market. There's been some highs, there's been some lows, and for some of us we might have done incredibly well. But I suspect that the amount of people that invest in the securities world is not in any way proportionate to the amount of people that fully understand stocks, bonds, and mutual funds. I consider myself a fairly educated individual. I did the things you're supposed to do. I went and got a solid degree. I got an economics degree, so you'd think that I should have some basics of understanding and some knowledge about the stocks and bonds and stuff like that. And the reality is it's very difficult to make money in those avenues unless you are an absolute expert on those asset classes. But let's ask ourselves a few questions. Let's say that we're just going to kind of go with the flow and do what everyone else is doing because that seems to make sense, and surely everyone can't be doing their own thing. First of all, over the last few years, we heard about a lot of people losing a lot of money, and it's almost as if it's been comforting to us to hear, well, that happened to all of us, and that's just the way the cookie crumbled, and there's ups and downs, and it's all about the long term. I still haven't had any advisor or any sophisticated stock investor that can explain to me how long the long term is supposed to be, because if we look over the last 10 years, the stock market has essentially been flat. If you were just kind of tracking the S&P 500, you really haven't made any money. So 10 years in my mind is a relatively long period of time. But when looking at stocks, when we purchase stocks, can we ever purchase those stocks at a discount? If stock's selling for $20 a share, can we go to the sellers of those stocks and say, I understand you're trying to get $20 a share, I'd actually like to offer you $13 or $14 a share? No, the reality is that whatever the going rate is for the stock, that is what the stock is worth, that's what you're going to pay for it, and you're just kind of susceptible to whatever the market is currently offering you. You're not able to negotiate in any way, shape, or form. It's just kind of whatever the prices are, that's what you're going to pay for it. And in non-traditional assets, there's a lot of avenues in which you do have a bit more control as to what you'll pay for assets, and you actually can have some level of expectation as to what you might be able to get for a certain asset. So for example, if you do a promissory note, let's just say you're going to lend money to an individual, you know on the front end of that investment what you're actually going to be yielding for your investment dollar. It might be 6, 8, 10%, 12%, whatever it may be, but the reality is you actually have the ability to understand and track and know where you're going so you can plan. Do you make money if the stock goes down in value? The reality is if we look at the climate, everything's gone down, whether it's stocks, bonds, real estate, and so you're saying to yourself, well, all assets have gone down, so who's to say that real estate or precious metals or private placements or whatever it may be is any better than stocks and bonds? And as we said, certainly we're in complete agreement, everything has gone down. However, if you purchase a stock for $20 a share and at some point down the road you decide you want to sell that stock, if the stock is now trading at less than that $20 a share, let's say it's now trading for $14 a share, which a lot of stocks have certainly gone down that much in value, you can't make any money. If you sell, you're going to lose money on that stock. Versus with real estate, for example, let's say you purchased a property for $40,000 and 5 years down the road the property is now worth $25,000 or $30,000. Sure, you're not going to be able to sell that property at that moment to make any money, but let's look at that period of time, let's say over the last 5 years. You could have still rented that property, so even if the value's gone down in value, you actually could have increased your wealth by just simply renting that property. So there's a lot more flexibility with other assets such as real estate. Do you truly understand the stock market, or is it an educated guess? As I said, 90% of the population easily is invested in stocks, bonds, and mutual funds, and I wager that no more than 5 or 10% of the population can read different stochastic charts and things like that that you really need to fully understand if you're going to be investing in something like stocks or bonds. I think most of us can look at a piece of real estate, possibly work with a real estate professional or an investor and come up with some idea of what the value of that asset is, and so thus they have a basis of understanding what the true value of that asset is. Certain things such as real estate just seem a lot easier for us to actually evaluate and understand if it's a good investment. Certainly most of us have purchased a property in our lifetime, and hopefully most of us actually made that investment understanding what the current value was. And then lastly, diversification. When I hear from individuals, I'm diversified because I'm invested in different types of stocks, that makes me cringe a little bit, because as we said, over the last, especially the last 5 years, it's been incredibly volatile, and with the stock market going up and down and all the way around, whatever the trend is with the stock market, that's what's inevitably happening with your stock. So it really doesn't matter what stocks you're in. If the entire market's tanking, you might lose 30, 40, 50% in value. Versus if you have, let's say, some stocks and bonds, but you also perhaps are lending money to an investor on a piece of real estate, well, the stock portfolio might be doing pretty poorly the last couple of years. You've gotten in at the wrong time, you've gotten out at the wrong time, you've just kind of made a mess of that. But let's look at the lending opportunity that you took advantage of, and let's say you were making 10% on your money. Well, 10% year after year, that certainly starts to add up after a while. So you can understand that diversification is much more beyond diversification in one specific asset. True diversification is investing in completely different assets that are in completely different avenues. So it's important that we understand, in terms of planning for our financial future, we first have to be honest about whether what we've been doing is working, and if it hasn't, investigating options that we might feel a little bit better about. Next slide, please. So that brings us to the definition of insanity. A few years ago, we had the huge dump in the stock market. I believe it was around 2008, where everything took an incredible dive. It wasn't uncommon to listen to an individual say, I lost 30, 40, 50% of the value of my entire retirement account. My personal wealth also took that incredible hit that was tied up in the stock market as well. But then shortly after, we saw these same individuals saying, well, it's going to be better this time around. We're going to go in there and we're going to put our dollars right back into the stock market. And what's happened? We've seen the highs, we've seen the lows, but it's a roller coaster ride that we do not have any control over. We want to educate you that there are things that you can do and take control of your financial future. If you're continuing to do the same thing over and over again and expecting different results, that's going to be a real issue. So this is what we're here to do, is to make you aware that you don't have to stay on this crazy roller coaster ride that they call the stock market. Next slide, please. So this is a slide of investment strategies, and certainly this is really just the tip of the iceberg when we're speaking about self-directed investments. As we'll see in a few slides, the way the IRS code is written is that it actually tells you what you cannot invest in with your IRA or 401k. The IRS does not give you a phone book of different assets that you can purchase with your IRA or 401k. So certainly the financial advisors of the world have done a great job of educating you about different stocks, bonds, and mutual funds that you can purchase. We're now here to educate you on the things outside of that securities world. So certainly Scott and Travis, they're certainly incredible entrepreneurs in this real estate world. So the majority of what we'll be speaking about are real estate-based assets. Certainly starting with the physical real estate itself. Your IRA or 401k can actually purchase and own anything from raw land to condos, single-family houses, commercial buildings. The physical aspect of real estate can actually be acquired by your IRA or 401k. This is your IRA or 401k purchasing that asset, just as you could purchase stocks or bonds. It's actually owning the asset. It's not owning a REIT in the stock market. It's owning 123 Apple Street. This is actually owned by your retirement account. That's the physical aspect. There are more quote-unquote passive ways you can also be involved with the real estate world. If you feel like over the long haul something like a hard asset like real estate in some way, shape, or form makes sense for you, but you don't necessarily want to deal with the tenants and the toilets and all that good stuff that you get to deal with as the active real estate entrepreneur, you can actually act as the bank for other investors so that you're holding a note secured by that property and you're getting a rate of return from that note. So you can actually hold a mortgage or a deed of trust for a property, something such as a mobile home. You can actually hold a lien against the title to a mobile home, for example. So this is actually passively being involved in real estate, and your IRA is actually acting as the bank. It is actually going to give that investor the necessary funds to purchase that property, and the investor as well as the IRA account holder are going to come up with the terms that they deem appropriate for that investment. As I said, we're a neutral third party, so those two parties are going to work out the terms of the agreement, and as long as everyone's happy, you can proceed and be involved in that more passive way. Certainly tax lien certificates is also a favorite of the client base. There's also the movement of private placements, which I think is interesting, in which individuals are investing with privately held companies, not necessarily these big Fortune 500 conglomerates, perhaps investing with people in your community that you know and get to actually meet and spend a little bit of time with personally. I think that's one of the great things about this industry is individuals investing in one way, shape, or form with other investors. So that's really kind of a neat and interesting strategy that we're seeing. Certainly getting back to the hard assets, precious metals such as gold and silver has recently become a favorite of the client base. As you can see, there are quite a few options on this list, and we could probably spend the next 3 weeks talking about different things that our clients have purchased. But we just want to give you a flavor of what's out there and what's available for your IRA or 401k to actually purchase. Next slide, please. So the first example is going to be a private lending example, and this is the IRA actually acting as the bank and actually acting as a lender for another investor. So in this situation, Jack Brown has $100,000 in a rollover IRA, and so in this situation, perhaps Jack Brown had a thrift savings plan, and he decided that he was going to roll that over into an IRA with us. It's what we call a qualified movement. That comes into us as the traditional IRA. So Jack Brown has $100,000 in that account and wants to loan it to an investor as a first mortgage on a property worth $135,000. Now certainly Jack Brown's going to do his diligence to make sure that that property is in fact worth $135,000. Please don't ask our office as to what we think the value of that asset is. As I said, we're certainly a neutral entity in the transaction. So let's look at this deal. Jack Brown is going to actually be lending on this property at 75% loan to value. Now, for those of us that are familiar with real estate transactions, that's a pretty solid loan, 75% loan to value. Certainly, you can have your own criteria. Don't use this as the be-all and end-all. We've had clients that thought they could only lend at 75% loan to value. It's going to be 9.5% interest rate. Once again, Jack and the investor agree to those terms. It's going to be interest-only payments with a balloon in 5 years. So essentially, it's not going to be amortized at all. Next slide, please. So from the IRA's perspective, Jack is going to complete our form, which we call a bi-direction letter, for the new note. And then either a title company or an attorney is going to prepare the note and the closing documents stating that Jack's IRA is actually the lender on this property. Jack is certainly going to review and approve all documents, and American IRA is going to be signing on the dotted line on behalf of the IRA for any and all documents associated with the investment, and we'll certainly either wire the funds or send a check to closing for that property. In some states it's a mortgage, in other states it's a deed of trust, but whatever the security instrument is, it'll be recorded and it'll actually be held by American IRA in our fireproof safe. So as you can see, the transaction is a pretty straightforward transaction for any individuals that have done any private lending with their personal funds or have ever actually borrowed money. The only thing that's changing is that the owner of this note is actually the IRA as opposed to Jack, and the administrator, in this case American IRA, is actually going to hold the instrument. Next slide, please. So if we're looking at the breakdown of this deal, in this case, because it's a rollover or a traditional IRA, that's what we call a tax-deferred account. You have not paid taxes as the money went into your retirement account. You will pay taxes on the money when you take it as a personal distribution in your retirement years. It is going to be a tax-deferred monthly payment of $790. In this case, it is paid monthly to Jack's IRA. American IRA records monthly payments and Jack tracks his payments via online statements. So it's important to understand that Jack is always abreast of the inflow and outflow of cash, and you can check that on our website. In 5 years, the loan is repaid. So what has transpired over that 5 years is that Jack's IRA has actually made $47,400 of interest from the note. So essentially that's $790 that he has made over the past 5 years each month, and that accumulation is a grand total of $47,400. And then certainly the initial principal is also repaid. So essentially Jack took $100,000 from his IRA, and in 5 years later, using a 9.5% note, he created $147,400. And certainly this is something that we see every day coming through the office. These are not pie-in-the-sky numbers. It is, however, very important to understand that the IRA is not going to be able to lend to what we consider a prohibited person. Now, a prohibited person is Jack personally. Jack's IRA cannot lend money to himself, his spouse, or any lineal family members. And by that what we mean is his grandparents, parents, children, grandchildren, and their spouses are also considered prohibited people. So Jack can lend money to his brothers, sisters, aunts, uncles, cousins, friends, individuals that he works with, individuals that he meets through different investment arenas, just as long as they're not in that lineal family member chain. Next slide, please. So this is an example where we're going to try and fly through a bit and make sure we can get through all the information here, but this is the IRA actually purchasing the real estate itself. The IRA is going to own the real estate. It's not going to lend money. It's actually going to own the property. And so in this case, Steve locates a property that is priced below the current market value. His IRA purchases the property for $100,000. Next slide, please. Steve's IRA uses $15,000 to fix the property up. Certainly nowadays, if you're getting a good deal on a property, a property owned by a bank, a short sale, or a owner that's in distress, usually it's going to need some work. So we need to understand that we need a significant amount of money over and above what's needed just simply to purchase the property. We also need the fix-up money. We need a lot of money, what I call the slush money, for the different things that arise during the life of ownership. So the property, in this case, it takes 2 months to sell. Now the reality is, if you're doing a fix and flip with your IRA-owned property, let's be honest, it might take 2 months, it might take 6 months, it might take 12 months, who knows. But the reality is as long as you own that property, there are going to be holding costs, such as taxes and insurance, that are going to be accruing. There's not going to be a mortgage payment because Steve's IRA paid cash for this property, but it gives you an example of what can be done. So there's $15,000 in repairs and another $500 for the holding costs, such as taxes and insurance. Next slide, please. A buyer comes along and purchases the property for $155,000. So Steve was sophisticated in that he found a property priced well below market value, or he did an incredible job negotiating, whatever the case may be. But the proceeds from the sale went back to the IRA. It's important to understand, if the IRA owns the asset, it's responsible for all of the expenses, the purchase price, the repairs, the holding costs, anything that arises during the life of ownership if the IRA owns 100% of this house. Now on the back end, when the IRA sells this house, the IRA is going to get 100% of the money from the sale of this house. And once again, the gains will be either tax-free or tax-deferred. If you have an account such as a self-directed Roth IRA, then that will be a tax-free account. Something like a tax-deferred account will be a 401k, traditional IRA, SEP, simple, something of that nature. Next slide, please. So we'll look at the breakdown of what's transpired with this acquisition. The initial purchase was $100,000. The carrying cost was $500. And the rehab cost was $15,000. So all told, the IRA was into the property for $115,500. Now the property sold for $155,000. In this very straightforward example, we're going to assume there was no realtor's commissions. The account holder actually found an owner. They worked the deal out themselves, so there was a net profit of $39,500. Now certainly this is an incredible turn of the money, and especially if you're able to do it in a 2-month period of time, you would be quite a successful investor. But the reality is that there are people doing fix and flips still in this market. Next slide, please. Now certainly before we get to the prohibited transactions, or I should say the prohibited assets, I do want to mention one thing. It's unfair for us to sit here and bash the stock market and talk about how it's gone down in recent years and it's not a quality investment vehicle for clients. The reality is certainly in most areas real estate has gone down in value as well. The great thing about real estate, however, is regardless of the current quote-unquote value of the property, what you can sell it for, there are always ways that you can still derive income from that property. If you have a rental property and you purchased it for $70,000, and let's say it was in Florida, for example, and now it's worth $30,000, unless you're trying to sell the property, you're not concerned about that if you purchased it for income. One of the things I find very appealing about Travis and Scott and their business model is that their model is based upon rental income. So the value of the property is certainly secondary to the income that property derives. Because with stocks, if you purchase it for $10 and it's now worth $5, you're going to have to hold on to it to make $1. If you purchased a property for $70,000 and it's worth $30,000, if you're getting $700, $800 in rent, you're not concerned about that until the day you're trying to sell it. So there are some differences between the hard assets and the securities-based assets. So when we're looking at prohibited assets, these are the things that the IRS tells us we cannot acquire with our IRA or 401k. And so in this example, antiques, alcohol, art, and others such as life insurance policies, these are the things that the IRS tells us we cannot purchase with our IRA or 401k. And certainly feel free to speak with your CPA or attorney about this. Please reference IRS code 4975. That's the specific code that talks about prohibited assets. Next slide, please. So investment restrictions. We touched on this with the private lending. The prohibited transactions involve your IRA and a disqualified person creating a prohibited transaction. So for example, your IRA cannot lend money to a lineal family member, their spouse, or the account holder. The IRA cannot purchase an asset from those prohibited people. It cannot buy an asset, sell an asset, exchange any goods or services. So it's very important to understand the IRA needs to stay away from any purchase, sale, or exchange of goods or services with those disqualified people. While we're talking about real estate, if your IRA or 401k actually owns a property, we need to make sure that you understand you cannot add any services. This needs to be a purely passive investment. You cannot provide the sweat equity to fix the property up. You need to be very passive. That's why many individuals decide to simply lend money to other investors and get a rate of return that's well secured. Next slide, please. So there are a lot of ways that you can get involved with American IRA and open an account. You can certainly create a new retirement account. For example, if your current retirement account is tied up in a thrift savings plan, something of that nature, and you're currently active in the military, you're more than likely not going to be able to move that thrift savings plan. But you can certainly contribute to a new retirement account, such as a Roth IRA, traditional IRA, whatever you deem appropriate. So the transfer is moving an existing IRA to American IRA, and it's going to stay the same account. Traditional IRA to traditional, Roth to Roth, et cetera, et cetera. It's a qualified movement, and there's no taxable consequence for moving it from one institution to another. Next slide, please. The next example is what we call a direct rollover. So for example, if you have a pension plan, a 401k, or a thrift savings plan, you can do what's called a direct rollover, and that would come into American IRA as a traditional IRA. Once again, it's a qualified movement. As long as it is a direct rollover, there's not going to be any penalties or taxable consequence for that movement. Next slide, please. There's also what we call an indirect rollover. Certainly not something that we suggest for clients, and that is actually the ability to take your existing retirement account, have that institution send you personally those funds. You have a 60-day window to get those to another institution, or else it is considered a full distribution of your retirement account, and there's a huge taxable consequence for making that decision. Also, if you're going to go this indirect rollover route, the current custodian is actually going to withhold 20% of your thrift savings plan, your 401k, whatever it may be. So direct rollover, 99.9% of the time, makes the most sense for clients. Next slide, please. So we certainly try and make the process as easy as possible. I don't want to take up the whole night extolling the virtues of American IRA. Certainly this is Scott and Travis's presentation. I certainly greatly appreciate them allowing us to be a part of this. So we want to make sure we move on to that final slide there, please. Self-direction. If you get nothing else from my presentation this evening, I hope that you understand that your IRA or 401k has a lot of options outside of the securities world. The key is to always invest in what you believe in, what you understand, what you think is going to get you to that final destination of actually having a proper retirement, not needing to supplement that income with additional work if you don't choose to have that additional work in your retirement years. So we feel if you're investing in what you know and understand, you're going to get a better rate of return because you understand it and it makes sense to you. Next slide, please. And this is my contact information. I do believe that on following slides, Scott and Travis have provided that as well. So I certainly appreciate you allowing me to spend a little bit of time discussing the self-directed IRAs. And as Scott said, I will be hanging out for the remainder of the presentation, and we'll be going into question and answers at the end. So I'll turn it back over to Scott and Travis. And once again, thanks so much, guys, for allowing us to be a part of this presentation.
Yeah, Sean, thanks a lot for that. That's a great rundown, and you really set the stage well for what self-directed investing is and is not. We certainly appreciate you taking the time to do that. And what I'd like to do now is, folks, we're going to shift gears, and we're going to take what Sean has developed as a baseline here, and we're going to give you some specific information on how that approach can be applied when investing with Pisgah Brothers, which is the company that Travis and I own as leveraging private investors. Travis, we have about 15 minutes, just under that. I think you need to take the time to lay that out. And then if we have Q&A, we can certainly bump a little bit into the new hour there. But I'm going to turn it over to you to lay this out for us. Since we're recording it, let's get as accurate a picture of this as we can. So without any further ado, I'd like to introduce my brother Travis, who will step you through how it works, self-directed investing with Pisgah Brothers. Over to you, Trav.
Hi, everyone, and thanks, Scott, for the introduction. First off, I'm really excited to tell you a little bit about the market that Scott and I operate in and why it's so attractive to us. First off, I know a lot of people wonder why trailers or manufactured homes, as we like to call them. That's certainly the business that Scott and I have found ourselves in the last 5 years, and what I want to do is just kind of take you through some specifics and tell you a little bit about that tonight. Well, first off, North Carolina ranks second in the United States for the highest percentage of mobile homes, and almost 17% of the population live in these structures. Now, those are 2004 numbers, but wouldn't expect a huge change between then and today. Moreover, in Catawba County, our priority growth market, that number is even higher, and 1 out of every 4 homes in the county was made in a factory and then transported to the site on wheels and axles. Everyone here tonight has heard about the foreclosure mess. We all know about it, but not everyone sees it as opportunity like we do. Tens of millions of Americans are going to lose their home as a result of this foreclosure debacle. And the question is, what happens to those empty homes? It may be hard to get an accurate number of how many are out there right now or at any one time, but I can tell you this, in our market, they are everywhere, and foreclosures are rampant. What's amazing is that the low interest rates and all these cheap prices for the foreclosed homes make them very affordable. Why aren't people buying them? Well, in the past decade, home ownership has fell to 65% in the U.S., which is down about 1% from 2000. Doesn't sound like much, but it's the largest decrease in home ownership since the Great Depression. Why aren't there more buyers out there? Well, buyers in our price range, in this price range, can't get a loan. It's simple. 43 million Americans now, or over 25% of the consumers, have a credit score of 599 or less, putting them in the high-risk category to lenders. Back in 2009, less than a year and a half ago, the FHA increased the requirement for an FHA loan, which is the predominant vehicle that would be used to purchase one of these homes, to a minimum credit score of 580, and that was down from 620. They raised it to 620, up from 580 in the previous years. These folks can't get a loan, and they're not going to be homeowners for a long time to come. What does that mean? Well, they're going to have to become renters. For us, the growing number of renters that are seeking affordable housing is absolutely going through the roof. So we constantly acquire properties, put them on the market, and see that in very short order these properties are being occupied because there's such a demand for the rental units in the market today. Also, what makes us different is that we have a top-notch management company called IPM, which has got over 100 rehabs under its belt. We spent the last 3 or 4 years building a management company to take care of these day-to-day management problems that we see in our market and in our niche investment area. And the management company has become quite well adapted to deal with the challenges that we face when the property is purchased and making the repairs and putting it into operation. So now let me just take you through the generics of how a self-directed investing deal would work with us. First of all, as Scott told you, we're building a network of financial friends. So first and foremost, that investor becomes a member of the Pisgah Brothers Self-Directed Investing Network. Using the principles that Sean talked about earlier with self-directed IRAs, that investor is going to go off and create a self-directed IRA account. Again, we use American IRA, and we certainly believe in what Sean and his folks are doing there, and we think that they're certainly in a good position to take care of you and make sure that those accounts are looked after. Next, we're going to locate an asset and then go out and conduct the due diligence required to make sure that we're getting a proper asset for the investor. We're going to let the investor know that we've got an opportunity on the horizon, and then we're going to work with that investor to loan the money on a promissory note with favorable terms back to the investor, similar to the example that Sean gave previously. And then, of course, we're just going to make those payments back to American IRA or whoever the custodian is. The individual will not see the payments, but he's going to see the monthly statements or go online to know that these monthly payments are being made back to the IRA. So essentially, that's how the deal works. Let's go through a little bit more of a specific example. This is an example that involves one of our current investors. Names have been changed, of course, but let's just assume that Cody has a self-directed IRA account with a balance of $35,000. I'm going to cut through Sean's numbers a little bit and get down to the numbers that we deal with. And the average price that these homes and land can be purchased for on the market today is between $30,000 and $40,000. There is a tremendous amount of fix-up cost that goes with that, certainly compared to the percentage of capital required to purchase the asset. Sometimes the repairs can be quite extensive. However, in most cases, the entire package is ready to go for $35,000 to $40,000. So in this case, Cody's got an IRA with a balance of $35,000 and wants to invest in Pisgah Brothers. He notifies us that he's ready to go, and we locate a deal that roughly matches that investment capital. We'll then work together to execute a promissory note, and in this case for $35,000 at 10% interest for 8 years. Sean pointed out the mechanics of this, but literally, a bi-direction letter and a one-page promissory note are about the only documents required to get this deal going. If there is a deed of trust involved, that's a little bit more complicated, but pretty cheap and pretty easy to put into place. We'll then acquire the asset and put it into rental operation and begin making those monthly payments back to the IRA account, in this case of $530. Of course, the difference in risk is, since Cody's IRA simply lent the money on a promissory note, we are taking the full responsibility and risk of managing and operating the property for cash. So Cody's asset gets paid regardless of the performance of the asset, and he's going to continue to receive that monthly payment. At the end of the loan, Cody's received about $16,000 in interest, and his account is up to about $51,000. And let me just reiterate that we absolutely put a premium on paying the investors first. A lot of guys that get involved with real estate at the age that Scott and I have a lot of leverage. We've got a lot of different irons in the fire, but certainly, the fact that we're here talking to you tonight and using our existing network of friends and family and military members means that we're very confident in our ability to put these rental assets into operation and to be able to make the payments back to the investors. So we treat it as a very serious deal when we take someone's money, especially through their retirement account. So an absolute premium being put on paying that investor first before anything else. So that takes us to how to get started. First of all, you can contact me. That's my email address there. I'll also just give you my phone number. It's 828-348-4230. So if you've got any feedback about anything that you've heard tonight, I'd love to hear from you. Pisgah Brothers is in the process of building our website. I know it's a little bit frustrating that it's not up right now, but it's going to be coming soon, and I'll be sure to send out an email to all the participants tonight within a week or so when that website is up and running, and we'll have this recorded webinar hung on the site so that you can go back and view it, listen to any parts that were interesting to you, or you may have questions. You can contact Sean directly at sean@americanira.com. Also at their website, www.americanira.com, and I think at that website, Sean, you've got your phone number listed there and how they can contact the office. That was also on your title slide. So Sean's wonderful at discussing individual problems, so everybody's situation is a little bit different, so I encourage you to pick up the phone and give Sean a call to get started with that self-directed IRA account. Okay, well, that pretty much wraps up the presentation. Scott, I'll turn it back over to you for closing comments, and I'll just take a second to go through any questions that we've got out there. Anybody in the audience tonight who wants to raise their hand and type a question is free to do so, and I'll do my best to manage those from my end. But in the meantime, Scott, I'll just turn it back over to you.
Okay, Travis, while we're waiting to see if anyone does have any questions, one thing that was going through my mind that our friends may be thinking about is, Sean, could you address, is there a limit to how much I can contribute to my IRA annually? And also, a second part to that question, is it possible for my spouse and I to both have a self-directed IRA?
That's a great question. And when we're looking at retirement accounts, keep in mind there are some different flavors, but making the assumption for a moment that an individual is going to be contributing to either a traditional IRA, which is a pre-tax account, or a Roth IRA, which is a post-tax account, which is, I'd say probably 95% of our clients fall into that category. For individuals that are under 50 years old, you can contribute up to $5,000 per year, assuming that you do in fact have earned income. And if you're 50 and over, there's what's called a catch-up provision where the government allows you to contribute an extra $1,000. So if you're 50 and over, you can contribute up to $6,000 per year. And certainly any individual that has earned income has the ability to contribute to an IRA. So certainly spouses can contribute to their own retirement accounts. We actually have young individuals that are 10 or 11 years old. If they have earned income, they can also start a retirement account as well. So it's pretty much open to almost all that want to contribute.
Okay, Sean. And then also, could you just, as far as no issues with having an account for me and my wife as well? Is that that's allowable?
That's certainly allowable. Each individual can have the retirement accounts are individual accounts, so each spouse can in fact have their own individual retirement account, and in fact they have to have their own. They can't combine it into essentially one family retirement account.
All right, thanks, Sean.
Travis, any questions flowing on your side?
Yeah, it's Travis here. I just got a few. One is in regards to SEP IRAs and how they differ from 401ks or any other type of plan, Sean. Or if someone has a SEP IRA or if they establish a SEP IRA, is it any different, in terms of investing with those funds compared to a Roth or a traditional?
That's a great question, and any self-directed retirement account can invest in any assets that the client deems appropriate. So whether it's a Roth, a traditional, a SEP, a simple 401k, thrift savings plan, any of those accounts, as long as they're self-directed, can invest in any of the things that we've spoken about tonight. So the SEP is one of those different flavors we spoke about where you can contribute more to that account per year. It's essentially 25% of compensation, or $49,000. This is for, of course, 2011, and that's for your max contribution for the year. So it definitely allows you to put more into that account. Certainly, if you're over 50, you can contribute $54,500 to that retirement account. So it's one of those accounts that's kind of an IRA on steroids in terms of how much money you can contribute each year.
Wow. So one of the problems that we've discussed in the past, Sean, is folks that have a TSP account who are continued employees and plan to be active employees of DoD for quite some time. There's not much they can do with their TSP plan. So if they wanted to start a separate account outside of that, obviously, creating an account with you guys with just a traditional or probably preferred Roth IRA, there's some limiting factors there in terms of contribution limits and what they can put in each year. But if they have children who wanted to, and they wanted to take care of those educational obstacles that are on the horizon, then it's pretty aggressive what they can contribute.
Absolutely. There's, boy, we could spend probably a few days speaking about the different tax-deferred, tax-advantaged accounts out there, and certainly I'd love to speak with each individual about their situation and see what options are available. But educational savings accounts, health savings accounts, different employer-sponsored plans, employee-sponsored plans. There's a lot of great tools out there.
Okay, there was a question about just the way that a promissory note is considered, Sean, and I think I can almost answer this, but I guess there's a little bit of confusion on exactly how it is considered compared to something with that's going to have dividends or something. So it's a simple repayment plan. In other words, if $50,000 is borrowed, then at 10%, and those it's amortized over the term of the loan, and those repayments are paid back into the account, and that money sits in the account until it is reused. But Scott and I have numerous examples where we have investors who have invested money with us, and then once that balance reaches a significant milestone, be it 10,000 or 20,000, then certainly we start talking to the investor again about reinvesting that money. And as the money comes back into the account, Sean, they've got all the options of self-directed IRA at their disposal, right?
Exactly. Yeah. The nice thing about the retirement accounts is that you can have diversification if you're looking to do some promissory notes and be involved in different assets and different ways with the cash as it comes in. You have true flexibility. You're not going to need to set up a different retirement account to invest in different sorts of things. All of it can be done under a single self-directed umbrella. So as you said, if the interest is accruing and you're looking to place that back in with Scott and Travis on another promissory note, you can certainly do so. Absolutely.
Travis, if I could, just one thing I'd like to comment. This is Scott again. For those who are looking to aggressively grow their IRA accounts, there's a guy named Peter Fortunato who lives in the St. Petersburg area that is a virtual legend in his ability to develop a wealth through self-directed investing. He has a range of courses that he conducts. You can Google him online. But if memory serves me, he started years ago with something like $5,000 in a self-directed IRA and has just amassed a fortune, a real estate fortune in options and paper. And actually has quite a few courses on how to do this. So it's bigger than just notes, and there's lots of ways to go at it, and he's certainly a good place. Peter Fortunato, Google him, and he has a lot of techniques on it.
Yeah, okay. No, great comments, Scott. And I think we're kind of going over time here a little bit, so I'm just going to start to wrap things up. And one of the things that I want to mention, being a student of self-directed IRAs myself, I certainly don't know all that there is to know. It's an entirely new world that was introduced to Scott and I a number of years ago. But one of the things that I can tell you is there are some advanced techniques that can be used with self-directed IRAs to to amass your retirement fortunes and wealth much faster than even the stuff that we've talked about tonight. And while the numbers that Sean threw out there, and hopefully the numbers that I threw out there were impressive, there are ways of using options and other things, buying and selling real estate, kind of like Sean talked about, that can get you across the goal line much faster. And I think in the future we certainly plan to have at least one, if not two, different additional webinars on more advanced techniques with self-directed IRAs. So I encourage you guys to go out and learn as much as you can in the meantime, and hopefully in the coming weeks and months we'll have additional webinars where we get into some more advanced topics and talk about faster ways of getting to the financial freedom goal line, so that you can enjoy those things that are most precious to you. And lastly, Scott, I don't have a slide that talks about our upcoming events, but we've been brainstorming over the last couple of weeks, and we're both pretty excited about some of the things that we hope to present to our new membership and our network. You have any comments you want to make about that?
Yeah, what I'll just close out with, Travis, is that, like I stated earlier, one of our goals is to leverage the network and bring as many entrepreneurial and investor subject matter experts as we can into this collaborative forum and connect them with our military friends and friends of the military. So in the next few weeks, I've been talking to guys like Steve Case and Dan Boone, who hopefully will come in and share some of their experiences and technical insights with us to explore all the options that are out there. And I think, Travis, after we're done here, we'll put out a follow-up email to our friends and just advise them of what's coming up. But every couple of weeks, looking to have a webinar like this to share that kind of financial and technical intelligence so that we can help everybody move forward.
No, that sounds great. And once again, I know that timing is always a challenge. Trying to figure out the best time that works for everybody. We're going to do our best in the future to keep these events at 1 hour or less. We're probably going to stick with the Tuesday night 8 o'clock theme, simply because we all work long hours, and I know it kind of interrupts the dinner and family routine, but we did put some thinking into it, some thought into it. And that's probably what we're going to stick with, although I do appreciate any feedback that anybody out there wants to give me. And of course, for those times that you're not going to be able to make it, we're going to do the best we can to record all these events and hang them on our website so that you can go back and listen to them at your leisure. So I'll be sending an email out in the future to announce the website and start sharing some of these informative sessions with our audience. So having said that, I think that'll wrap us up for tonight. So let me just take the time to say thanks to Sean for coming on and sharing his expertise with the self-directed IRA investing. Pretty excited, and I know that you guys, after hearing Sean's presentation, hopefully will get excited and go out and start learning some more about it and contact Sean, let him know what your questions are, and hopefully get started with some of the opportunities that are out there. Thanks again, Scott, for running the show, and unless there are any final comments or questions, that's all for tonight. So thanks everyone for attending. Really appreciate your time, and we look forward to bringing you some more valuable content in the coming weeks.